Hi everybody, and welcome to the ROI Research on Investment Gazelle AI breakout session entitled Our Global Economy, Adapting to the New Reality. My name is Stephen Jast, and I'm very pleased to act as your moderator for this session. So just a bit of housekeeping before we get started. This is a 60-minute webinar that will include a 45-minute presentation, followed by a 15-minute Q&A. The session will be recorded and made available to anybody who'd like a copy. So okay, let's get started. This year we've experienced how globally connected our economies really are, and how US trade and investment relies on the health of the global economy as much as its own. As we focus on rebooting our states, regions, and cities, international linkages can and will still be major engines of growth. They are a way to diversify our economy, support existing businesses in new ways, and help them reach new markets that they need now more than ever. In our webinar, we'll be reviewing how the US has been faring, where we're at in terms of our recovery, and which sectors are still struggling the most, and which sectors have started to see a positive turnaround. We'll also take a look at the global perspective, and more specifically, how trade and FDI patterns have changed, how new markets have come to the forefront, and how to assess the recovery of our key trade and investment partners. We'll conclude with an outlook on how these trends have impacted business attraction and FDI. Before we get started, let me introduce our speakers. Shannon Lynch. Shannon joined ROI this past year as VP of Business Development. Prior to joining ROI, Shannon was part of Frankfurt Rhein-Main's international team that saw her working closely with North American-based companies interested in growing their presence in the German and European markets. Shannon is a graduate of Wayne State University and obtained her master's degree in international business with a focus on German-speaking countries from Eastern Michigan University. Nadine Jeserich. Nadine leads ROI's analytics practice, focusing on cluster analysis, growth benchmarking, target industry analysis, and emerging market watch. Prior to joining ROI, in 2016, Nadine was the principal economist at Growth Economics. In this role, Nadine developed leading-edge benchmarking products that have directly influenced government policy, including unique entrepreneurship and business dynamism indicators to track high growth and mid-market businesses. Nadine received her Ph.D. from George Mason University in Fairfax, Virginia, and her master's in economics and business administration from the University of Maastricht in the Netherlands. So without any further ado, Shannon, the floor is yours.
Thank you, Steve, for the introduction, and thank you to everyone that is joining us today. I hope everyone is enjoying the conference to date and has been able to check out some of the great features for this virtual conference. As Steve mentioned, we are all aware that the pandemic has caused varying degrees of disruptions. So where are we at in terms of recovery? We keep hearing this word recovery, but what does that actually look like? And where do we actually stand? And how does the global recovery fit in with the US recovery? The pandemic has exposed several weaknesses across local economies, communities, and sectors. Both trade and foreign direct investment have also experienced disruptions. Personally, what I think is the most eye-opening is that the entire pandemic has shown how globally connected we are. Stereotypically speaking, most Americans tend to be very US focused, but in reality, there's a strong reliance on the global economy. It is exactly that strong reliance that makes us dependent on global factors, including how far along foreign industries are in the recovery and what trade levels indicate. When we start to really break down the global impact on FDI as a result of the COVID-19 pandemic, what does that actually look like? When examining the top 5,000 multinational corporations, downwards earnings in 2019 were down 30% due to COVID-19. FDI as well decreased by 40% in 2020 and is estimated to further decrease by 5 to 10% into 2021. Some of the hardest hit sectors include primary sectors, including mining and petroleum, which is down 70%, transportation and storage, down 63%, automotive and aerospace, down 50%, and not surprisingly, hotels, restaurant, and leisure is down by 94%. Most of these industries that have been the hardest hit make perfect sense given recent changes on how we work, socialize, eat, and changes to travel restrictions and COVID-19 lockdowns as well. To break things down further, just as different industries have been hit to various degrees, the economic impact varies globally as well. This is why it is so important not just to track US disruptions to businesses and industries, but also our main trading partners as well. When we look at these charts, we can see that the crisis has had a severe impact on the activity in 2020. That's not only as looking at the global economy, but also across the world as well. We can see advanced economies have been harder hit, of course, than emerging markets and developing economies. One thing to note is that there are positive signs for 2021. It is difficult to predict how long this recovery will take, as we can see every single geography has a positive prediction for 2021. We still won't know how long that will take. And before we dive into greater detail on the global implications, I would like to first look at where we stand domestically in terms of recovery. As I mentioned, predicting our recovery is a difficult and complex task. We currently see lots of models saying 2020 will be a year of recovery, but what actually is that telling us? When can we actually expect a recovery pre-pandemic conditions? When we look at this particular graph, it's interesting to note that there's two separate models here. There's a base forecast that says pre-pandemic conditions will be reestablished by November 2021. On the other hand, a very aggressive model is looking at January of this coming year to be that recovery point. In terms of where we actually stand in recovery, there are several factors we can consider. As a start, we of course track near-term economic signals, some of which you see regularly in the media, namely unemployment. These types of signals provide you with the most recent and regional insights into the economic impact of the pandemic than the type of economic data we are used to tracking. People, for example, these days pay a great deal of attention to unemployment claims. Of course, these matter from a regional economic perspective, but also a wider economic signal to outsiders, one that they need to help decipher and understand in the context of the specific state, regional industry mix, or state policies. As we can see here, there are several positive signs when looking at unemployment over the current months. From July to August, we saw job increases in 40 states. Economically, we've added 4.8 million non-farms jobs in June alone. The manufacturing sector has also seen strong growth with over 300,000 new jobs added, and hospitality has added 2.1 million new jobs. Of course, unemployment tells a story with positive indicators, but it's incomplete. New business applications have also increased throughout the year and are telling a slightly different story. Tracking new business applications, especially those that indicate payroll employment, give insights into how residents perceive the local economy and how confident they are in investing their assets. It could be, of course, that some percentage of these new business applications are what we refer to as necessity entrepreneurship, unemployed opting to start a new business to find some new way of getting by. It is also, of course, not entirely clear why applications are elevated when so many existing businesses are struggling and the level of consumer spending have not rebounded yet. Some of these surge may be a lack of applications, or maybe a backlog of applications or some type of delay, or existing businesses being bought up. So part of the surge could represent a churn in business ownership rather than actual new business formations. While all this churn and uncertainty, businesses' attraction often takes a back seat. But supplementing your economy with new technology, ideas, and capital can be the kind of boost to a regional economy that they actually need to support these new local ventures more efficiently. Regions that have been able to support new businesses typically fare better in terms of recovery. Job posting can also tell part of the story. Comparing months by month, the divergence of course appears stating in February with August, showing a narrowing of the gap, which is also interesting to see, as there are top occupations with active postings. Of course, active postings do not necessarily mean they are new jobs, but potentially looking for making changes and provide some type of insights into industry trends. So on its own, this data won't tell you the whole story, but are important to track as part of providing a profile to your region, as well as tracking which of your sectors might be in recovery mode or the labor market is ready for additional companies, and etc. So with all this data floating around and these different pictures being painted by this data, do we actually have a turnaround in sight? As we see by these numbers on the screen, the blue being a 6-month net job change prior to August, and the pink being 1 month from July to August of this year. What we can take away from this is that we are starting to recover. To continue this traction, we must start with our assets we have, as well as making the most of the diversity of your region and how we can expand clusters despite these disruptions. We can also look at what cluster linkages are missing, and then how can we use our workforce skills to best be leveraged. Similar to unemployment, manufacturing has always captured the attention of the American audience. When the main economic impact hit, these sectors were the hardest hit. And when you take apart, you can see several different paths of recovery for each industries. Some industries have fared better due to higher demand created by COVID-19, or more robustness in terms of the changes from the same month last year, such as certain food sectors, plastic, computers, and electronics. And you can see that the transportation, equipment, furniture, textiles are trying to make their way back. But you still have a long way to go in terms of output compared to May of 2019. Recent insights have shown that the new orders are in growth mode again in terms of supplier proposals, project planning and production investigations have also seen 2 months of slow recovery, but still are nowhere near pre-crisis levels. What all this data tells us is there is no broad brush to paint recovery under. This data can reveal which areas are better than others, whether by size, internationalization, or diversity of customer base. So if we're looking at economic concerns, what are businesses still worried about globally? In our previous series of webinars, we've discussed different supply chain disruptions, the trends towards consolidation, revenue losses, and the lack of demand. Worldwide, large corporations surveyed put a fear for a global recession at the top of their business concerns, while supply chain disruptions was only number 5. It's the lack of demand and the uncertainty of when the global economy will pick up again, and whether certain industries and certain regions will never recover. That is what driving businesses' investment decisions at the moment. What is interesting to note is the certainty of the companies for the outlook of the future. Very strong, you'll note on these graphs, you see growth prospects for the country, for the sector, and also for individual companies as well. ROI has also conducted our own surveys with decision makers. Since March of this year, we have spoken with almost 10,000 decision makers globally. Based on feedback on the impact of the crisis and their outlook, the least affected sectors appear to be transportation and logistics, with a mixed result for computer and electronics and energy and utilities. The software and application sectors surveyed include many smaller accelerating companies that saw either funding or demand halted, especially for the industrial market. However, 90% of these companies still expect a turnaround within 2021. Healthcare and life sciences have mixed results as well. Overall, the results are not entirely clear-cut, but again, there is some type of recovery being initiated. Several industries have also made it through 2020 more robustly than others. Some were more insulated from workforce disruptions, such as the tech and science sectors, which were already used to remote work, while others saw accelerated demand due to the crisis, such as the medical and food sectors. Again, some of these industries that we've seen growth, as I mentioned, medical devices, plastic products, food and snacks, computers, distribution, food and beverage. With the IT as well, we've also seen a big increase in growth mode post-COVID. In terms of cybersecurity or market research, areas that that reflect the changes of the way we live and work at the moment. As we've seen companies expanding, it reiterates we need to not only track just US businesses and industries, but also take a global approach. Understanding international supply chains matter in terms of supporting not only your local businesses, but fostering FDI as well. Here at ROI, we can personally attest that businesses are still actively expanding through there has been some substantial impacts here as well. So what are motivating companies to expand? What projects are they actually seeing themselves expand in? As we see from 2019 to recent surveys, the motives have primarily stayed the same. Skilled workforce is still the #1 priority for organizations and a motive for FDI, and then also the proximity to markets and customers. On the other side, we've also seen business activities as part of FDI projects shift slightly from the previous year as well. The data suggests a robustness of the business services sector with an emphasis on supply chains and distribution, both in terms of motives and business activities pursued. Our experience in regions across the US and internationally this year have told us that a winning recovery strategy requires close observation of our investment and trading partners. But Nadine will now talk about this global connection, including international trends, and why they are vital to our recovery in more detail.
Thank you, Shannon, and thank you to everybody who's listening to our webinar today. As we've already noticed from all the different trends and data elements Shannon covered, there are a lot of moving parts to keep track of this year. I hope to shed some light on some of the trends when it comes to changes in trade and FDI patterns, and how far these numbers and those of our trading and investment partners indicate a cause for optimism or more cautious concern. First of all, as part of the global economy, we want to understand where overall merchandise trade value and volume is at. We're still always about 2 months behind in most data sources, but we're looking for any changes in trends, ideally over more than a month or two. World goods exports and imports increased in July, but stayed below pre-pandemic levels, as many businesses continue to operate with limited capacity or had to shut down. And many countries still have some travel restrictions back in July. In terms of volumes, we saw a 14% decline in the second quarter of 2020. That is a more drastic drop than the 10% recorded during the financial crisis between the end of 2008 and the beginning of 2009. As of July of this year, the steepest declines in merchandise trade were recorded in Europe at about 21% and followed just closely behind by North America at 20%. Asia overall actually only saw a 7% decline. In terms of dollar value, we saw a 21% drop, which actually is less than the Great Recession, which saw a 33% drop, which gives you one insight into how different of a beast this economic struggle really is this year round. Now, of course, the question is what the next couple of months hold. The World Trade Organization has developed a leading indicator for goods trade that has shown to move about 2 to 3 months ahead of actual merchandise trade statistics. Readings of 100 indicate growth in line with medium-term trends. Readings greater than 100 suggest above trend growth, and those below 100 indicate below trend growth. The current barometer as of July, which would look basically towards predicting September and October and possibly November trade volumes, is seeing global goods trade at about 18 points down from the same period last year. This reading is actually the lowest on record in the data going back to 2007. Now, expectedly, the sub-indices for automotive products and air freight have fared by far the worst. Container shipping also remains really depressed, but overall export orders actually show signs of recovery. Indices for electronic components and agricultural raw materials have held up relatively well, showing only a modest decline. As mentioned previously, the 14% drop in global merchandise trade volume between the first and second quarter of 2020, together with this barometer reading, basically still indicates that world goods trade in 2020 will be around 13% lower compared to 2019, which is actually not the most pessimistic scenario relative to what the WTO modeled back in April. But it still makes a V-shaped recovery in 2021 less likely and an L-shaped recovery outlook more likely, which in my book, we can't really call it a recovery. It basically implies trade is going to flatline for a while. There's also a services trade barometer, but it is rather a coincident indicator. So rather than anticipating services trade, it is released often just before the actual trade data, and therefore at least can give some more recent insights. And there, for example, we have seen that ICT services actually fell below 100 despite a robust demand for these services during the pandemic. The financial services index was the only sub-index that actually remained on trend as of mid-September. Now, as with all regularly published data sets at the moment, especially those that rely on models, the WTO also acknowledges that the pandemic had such a fundamental impact on business and consumer behavior that the accuracy of standard economic data certainly has been reduced. As in all cases, we always advocate in getting the story from as many possible sources, and these days also to get higher frequency data, weekly or even ideally daily. For example, by tracking commercial flights or port shipping data. You saw, for example, container volumes in Savannah, Georgia, unexpectedly setting a new monthly record in August. And that's being attributed to US consumer demand for online shopping and home improvement goods. Tracking whether this consumer demand will continue to support that flow and whether foreign countries are able to support it is another metric of recovery. The US itself has seen exports and imports increase in July, but again, also below pre-pandemic levels. Our actual trade deficit, how much more we import than export, has accelerated since the pandemic and is still on an upward trend. The July deficit with Mexico and Singapore was the highest on record. July exports to Hong Kong and Singapore were the lowest since the Great Recession. But at the same time, imports from Taiwan were the highest on record. Understanding international supply chains, no matter what the way the wind blows, so to say, in terms of supporting your local businesses. The primary source of intermediate goods for US production, the inputs that are further processed into final goods domestically, are not just coming from China, but primarily Canada and Mexico, as well as several European countries and Japan. So understanding how some of these economies have fared during the pandemic, how governments have and continue to support the recovery, will play a role in strengthening and forging new trade and investment relationships. As of July 2020, most G20 member countries have committed to stimulus packages to try to soften the effects of the pandemic. Out of all G20 countries, Japan, relative to the size of its economy, has actually passed the largest stimulus package, amounting to about 21% of its GDP. Germany, UK, Italy have all invested the most within Europe. And some countries' measures, though, have started to expire or are about to be phased out, at least for industries that are not highly impacted, such as tourism. At the same time, just like in the US, we have seen new bills being introduced for more structural measures. You have, for example, France recently announcing a $100 billion plus plan that includes workforce training measures or a further emphasis on developing hydrogen energy, as well as reshoring more medical supplies. But how much of that has helped prevent further economic downturns or speed recoveries is really still something that needs to be determined in the next couple of months. Having a quick look at some of our main trading partners, we see that trade with Canada and Mexico started to show a turnaround in imports and exports starting in May. Now, July has seen some slowdown, which fits with the overall global trade picture, and that might indicate a slower return to 2019 levels than hoped. Imports from Canada and Mexico in both cases have a slightly faster pace than exports to these countries, indicating that the demand side in the US is still relatively stronger compared to Canada and Mexico, at least as of July. Looking at actual industry output can shed light into developments as well, impacting both trade and foreign investment. Industrial production in Europe, for example, in most sectors, looked like it was recovering well in July. The overall industrial sector was, though, still at around 10% below January levels in terms of volumes. The energy sector and non-durable consumer goods, such as food, across the US were actually not as heavily impacted, but durable consumer and capital goods really took a hit. Now, capital goods have so far seen a slower recovery, at least across all of the EU 27 countries. So which of our exports have actually been doing well? Out of over 100 sectors, only 11 really made it through the pandemic fairly unscathed, at least in terms of exports, or maybe even saw a little bit of growth. Animal food, a strong growth sector even before the pandemic, has continued to grow its export market, as well as several agri-food industries. Magnetic and optical media continues to grow, which includes home movies, video games, and a lot of these entertainment options accelerated by the pandemic and stay-at-home orders. Machinery also saw at least a strong turnaround in June and July. To focus a bit more on this market, we wanted to look at which countries have actually been driving this turnaround in machinery. Out of the top 20 export markets for industrial machinery, the countries that have seen the biggest growth in US exports in 2020 compared to last year have been South Korea, Japan, the Netherlands, China, Germany, and Singapore. Of those countries, exports to Japan and Singapore have increased the most since the start of the pandemic, despite our overall growing trade deficit with them. So for certain subsectors, there's still a growing export market available. Now, Germany, of course, as part of a machinery, industrial machinery hub, has always been one of our most reliable export markets, and also for machinery imports for that matter. Germany, as a case study, has been a top export market also for transportation equipment, pharma, and medical devices. So tracking its recovery is certainly of importance to the US market. Germany's industrial production index, tracking its output in July, is still substantially below the same month of last year. But some sectors have recovered notably compared to the situation in April anyways. Capital goods particularly moved from a decline of 45% compared to last year in production to 16% as compared to the same month last year, which it seems at least is more manageable in terms of going forward and moving into a recovery. On the trade side, Germany exports and imports decreased by 11% in July 2020 over the year. And what was driving that? Well, exports to China actually decreased by just 0.1% compared with last year. Exports to the United States, however, dropped by 17%. In July, most imports came to Germany from China, and those actually increased by 7.4% compared with last year. While at the same time, imports from the US fell by almost 15%, indicating really a shift in consumption patterns between different source countries. German imports from the UK were also down 25%. But trade data is still a very lagged indicator, as I mentioned earlier. So looking for leading or forward-looking indicators is a key. As of the beginning of September, sentiment among German managers has continued to improve, according to the IFO Business Climate Index. This is a survey of over 9,000 businesses in manufacturing, the service sector, trade, and construction. It climbed a second month in a row. It indicates that businesses assess their current situation as better than in the previous month. They also expect the businesses to recover further. In manufacturing, the Business Climate Index saw a noticeable increase, with both a more positive assessment of the current situation, as well as a more optimistic outlook for the near future. The electrical and electronics sub-industries in particular are optimistic. In the services sector, by contrast, the index fell over the past month, though companies still assess their current situation to be slightly better as in the previous month. In the trade sub-index, that was actually one of the sectors that improved the most. Companies were considerably more satisfied with their current business situation, and many of them assume it will improve further over the next months. And that bodes well for continued recovery in the July trade numbers. So despite rising infection numbers at the end of the holiday season, that also came with some new restrictions across Europe really, but also in Germany, the German economy does seem to be stabilizing. With trade being closely intertwined with investment flows, we would expect FDI flows to be as equally impacted. So let's have a look at the investment side of things. Foreign direct investment, of course, has seen a substantial drop because of the pandemic. Globally, services have seen a slump in both mergers and acquisitions and greenfield investment. But manufacturing has been hit much more in terms of greenfield investments. And pharma, while being considered a strategic sector and one talked about in the context of reshoring very often, has seen a switch to mergers and acquisitions as an expansion strategy during the crisis. So even when our investment and our trading partners' economies are in recovery mode, we won't quite pick up where we left off in terms of traditional investment strategies. Again, keeping these international trends in mind helps understand what pressures US industries are facing, as well as where business outreach might take on different strategies. The United Nations long-term outlook on foreign direct investment, whether greenfield or mergers and acquisitions or reinvested earnings, is certainly still sobering. In the short run, projects were put on hold. Reinvested earnings, a large part of what is considered foreign direct investment flows, have on average decreased by about a third between February and May, which of course will impact decisions on whether foreign affiliates are going to remain profitable and stay open. At the same time, several countries imposed new investment restrictions to avoid a fire sale of their domestic struggling firms, such as the EU restrictions on non-member investments. In the medium term, going into 2021, the lack of demand is really what will keep FDI down, according to the UN. Although in general, the trend in FDI reacts to changes in GDP growth with a delay, this exceptional combination of the lockdowns and the demand shock will expect to cause a much faster feedback loop on investment decisions. The demand contraction will hit FDI in 2020 overall and then fully unfold in 2021. That is the prediction. So it all depends in the end on the final numbers on our economy by the end of the year and whether investors and consumers are in a position and willing to get back to spending and investing. In the US, early indicators of incoming greenfield investments, expansions or new projects showed a 35% decline from the first to the second quarter 2020. And preliminary September numbers see it staying around the same level. The drop is mainly driven by the main investors for new outside investment in terms of non-regional investments, the US itself. That is really typically where most of our greenfield investments come from within our own borders. And there, the top expanding sectors in 2019, especially software and IT and financial services, have seen only about half as many expansion projects in the US in the second and third quarter compared to last year, which makes diversifying into international markets even more important. And opportunities do still exist. Even though, as of July, an Ernst & Young survey of European businesses found that about 10% of FDI projects were canceled and 25% more were frozen, over half of the businesses expect only a minor decrease in their 2020 FDI plans. So far this year, close to 9,000 investments have taken place globally, whether new or expansion. Over 38 different countries logged more than 20 projects each in 2020. So there is still substantial activity going on. What has happened this year in terms of investments coming to the US is that some countries have lost some market shares, while others have been able to hold on to their shares or even increase them. Although, as previously mentioned, total numbers of domestic projects have dropped, in terms of the share of FDI projects into the US, there is a slightly bigger focus on domestic projects. France and Japan have seen the strongest declines in market shares in the US, while Germany was able to hold on to its market share this year quite well. And the UK has actually shown an above normal activity in 2020 so far. Besides the fate of foreign economies dictating how feasible FDI projects currently are, the other interesting dynamic is that the reasons for site selection, as Shannon previously mentioned, have shifted somewhat as well, and also depending on the country we're looking at. This matters because of course it affects your pitch, how you position your state or region. For example, Japan, with a very hard-hit economy this year, they're still investing, is seeking government support, much more as a primary decision factor compared to last year. Of course, again, workforce and market access remain in the top. Workforce even moved up a notch for Japan. So where does that leave us? States and regions with mixes towards more robust sectors will have an easier time recovering, as well as those generally more economically diversified. And that also includes diversifying the sources of investment to more international markets. We need to track not just US businesses and industries, but our main trading partners to understand how to lead our conversations in these times. And we need to be aware that trade and investments and site selection and market access motives still persist to some extent as before, but the priorities might have shifted for some countries and for some industries. And that will impact the kind of strategies we're employing when we're producing talking points and outreach materials. Stephen is now going to talk a bit more about the implications for business attraction strategies going into 2021. Thank you.
Thanks very much, Nadine. Great job, and great job, Shannon. So what does all this mean? What does all this data mean for business attraction? There's no silver bullet, and sometimes in situations such as these, we really need to be most mindful of the basics. So what do we see going on right now in the marketplace as it relates to companies expanding and how that translates into your business attraction strategy? I think pretty much all companies are to some degree investment weary. Most companies that we've spoken to are focused on net income, revenue focus, top line growth, regionalization. They're reevaluating their value change and subsegments. And we've heard a lot about increased automation and digitization. And I think this falls mostly within the notion that many companies are looking to reshore. Given our cost of labor, it's become obvious that to offset these costs, we will need to explore different means of automation and a certain amount of retraining for our workforce. However, when we do consider the investment awareness of companies, and as Nadine had mentioned, reduction in investment in FDI, this leads us to a simple conclusion. We need to revise our strategy. This is an unprecedented time. And as I stated a bit earlier, sometimes what we need to do is look back at the basics, which we'll do in a couple of seconds. So if job creation is going to be a bit lower, if capital investment is going to be a bit lower this year, what is the most important key performance indicator for economic development organizations? I think personally, the KPI is how quickly you adjusted your strategy in an efficient and an effective manner. And how do we go about doing that? Well, let's take a look at the key considerations of companies pretty much on an industry agnostic basis. There are companies that are considering reshoring and that are looking at their supply chain and supply chain stability in a nearshore or onshore capacity. Some companies are talking about a +1 sourcing strategy, a nearshoring supply chain. And of course, this all relates to mitigating risk in existing supply chains with a possibility of decoupling from China. I think that decoupling from China will be extremely difficult for manufacturers for a variety of reasons. And we can get into an entire webinar just on the China issue. Just a sort of a quick little advert. We're going to be releasing a pretty comprehensive ebook in the next few days on reshoring, and particularly as it relates to decoupling from China. Another consideration that companies have, again, as we talked about before, is the increase in automation and digitization in their processes and deploying more AI in their decision-making capabilities. Other key considerations include massive investments in technology, AKA automation, massive investments in digitization, massive skills upgrading if we are to reshore a lot of the manufacturing that's taking place overseas. That'll relate to a need for enhanced worker productivity and output, and an availability of finance to help offset the cost or fund or strictly finance the cost associated with the acquisition of these technologies. Companies will also be very wary of employee safety measures. Companies don't want to close down because of a wave of COVID or because of a transmission situation that forces them to lock doors. We will see a lot of work from home. I believe that this is here to stay in some capacity or another in the new reality moving forward. I think people to some extent have enjoyed working from home. I think overall we've not witnessed too much of a lack of productivity and efficiency. So this will lead to a most definite footprint change in terms of real estate and the footprint for overall offices, I should say. Remote and virtual working models will most definitely proliferate. So this bodes well for second-tier cities. This also bodes well for more rural regions where folks may want to move and yet still have some very interesting job possibilities. So now that we've looked at some of the challenges and considerations that companies are facing, how does that translate into your strategy moving forward as an economic development organization? So we've taken down a few notes, and again, it's going back to the basics. So are your industry and geographic targets still viable from a business attraction perspective? Are the industries that you're looking to pursue still growing? Are they industries that are being hit very hard by the current pandemic? And if they are growing, are they still growing in the geographic regions that you had initially anticipated recruiting from? You need to reassess your budget and funding. It goes without saying that governments are spending a tremendous amount of money on recovery funding. So how will that affect you moving forward? What do your budgets look like? Where do you need to spend most of your budget moving forward? It's also very important to keep your stakeholders in the loop, particularly from a business retention and expansion perspective. The more people that we have in the loop, sharing intelligence, sharing ideas, sharing strategies, the better. Of course, business retention and expansion in these times is incredibly important. As we all know, the cost associated with recruiting a company is far greater than the cost of keeping a company. So first and foremost, let's make sure that our existing industrial fabric, meaning the companies in your backyard, are doing well, they're getting the services that they need, they're aware of all the different funding potential that they could be admissible to, and let's make sure that we're helping them access PPE where they need it, and that the companies that we have in place are healthy in every possible way. Let's revisit your value proposition. Perhaps now you're sitting in a location where part of your value proposition that may not have been highlighted now has become very important, and vice versa. Perhaps now the value proposition that you've been promoting is no longer quite as important as it was, given any changes that you may be making in your target industries and target geographic regions. Ensure that your mix of marketing collaterals are adapted to today's reality vis-a-vis targeted industries. Again, strengthen cooperation. And then it would do no harm to review the principles of disaster recovery. This may be important as some companies may be asking what the plans are in place to mitigate against another wave of COVID. So now is not the time to cease business development activities. A lot of our clients have been asking us what our thoughts are companies still investing, are companies still moving forward? We can tell you with all certainty that there still are companies expanding, investing in capital, creating jobs, and it's still very worthwhile being out in market looking for these companies. While we can't visit with companies face to face, we can still do virtual conferences. We can still show our shovel-ready sites through augmented and virtual reality. We can host meetings through digital and virtual meetings, much in the same way that we're having this conference. There's a lot of different digital marketing strategies that we can deploy. Videos are a great idea. So really, it's a question of seizing new opportunities from the changing FDI landscape. Thank you very much, everybody, for attending our webinar. We hope you found it useful and to be of value. It would be our pleasure to now answer any potential questions. Thank you very much.